Executive Director and Global Chief Finance Officer with Glenmark Pharma. Let's understand from him that which way he feels that things are moving both for the domestic and the non-domestic market. And post-COVID, now that the COVID portfolio for some of the companies has normalized, how exactly is the business trajectory moving? Mr. Mani, good morning. Thank you for joining us. Let's first understand the big picture from you. The products you represent, the markets you are in, how many markets are growing, how many markets are not growing, how many products are witnessing pricing pressure, and how many products are flourishing?
Okay. Good morning. Good morning to everybody. Thank you. So I'll try to break this question into a number of parts. So as far as our markets grow, like for India, okay, for the current quarter, our sales were at about 1,091 crores, which grew at about 12.7% compared to the previous year. As per IQVIA MAT September, we are ranked at about 14 and still among the faster growing companies in this segment. Over the last couple of quarters, we have improved our rankings both in the respiratory as well as the cardiac segments. And during the quarter, we launched about 9 products, and we have seen some market share growth both in the cardiac as well as the diabetology segment. Today, we have a number of products to meet the requirements of the patients for the type 2 diabetes in India. So overall, all in all, India seems to be showing good progress. And if you look at the other market that we are doing well is Europe, where in spite of the currency challenges, etc., we still grew at in excess of 11% during the quarter. And obviously, our Ryaltris launches in number of markets have also helped us there. And when we look at the rest of the world markets, while it looks like it's a degrowth, it's actually grown quite well because it's on the back of last year, where in the second quarter we had a large COVID-based sales, okay, COVID-related product sales. So this year we don't have those, but without that, we would have grown in excess of about 15%. Our API business, again, the external markets grew at about 11.6%. So all in all these markets did quite well. As far as the US market goes, I mean, it looks like a degrowth for the current quarter, but compared to the previous quarter, we have grown. And we are seeing some improvements in the coming 2 quarters. So all in all, we hope to achieve the sales pretty close to what we did last year. And in the next year, we're looking at a single-digit growth. So these are how we would look at the market. Few challenging times, but in spite of that, I think, I mean, while we had supply disruptions, logistic challenges, input cost increases. Add to that, in the current year, we have also had currency volatility, inflation, as well as the overall interest rates going up. But I think we continue to look at our objectives and our margin profile. We continue to maintain at about 19%, even in the current quarter, adjusted for the COVID portfolio. We are almost at 19%, and last 2 years also were at similar levels.
To add to that list of woes, you have costs as well across the board, which have increased. You spoke about maintaining margins at about 19%. So the question is, given that we're expecting costs to come down in the second half, can we see your margin profile improving?
I mean, as you can see in the first half, in spite of the challenges, at least the second quarter, we reached at about 19%. I would like to maintain the overall margin profile at similar levels and believe that, I mean, obviously over the years, these 2 years have taught us a lot how to manage costs better than what we ever did. In cost means not just cost, but also improving the efficiencies across the business. So I think all in all, I think we would like to maintain our margins and see that we can sustain it at similar levels.
If things are looking up, and if I look at the US business, the kind of commentary what you've given, why are you giving a guidance of 6 to 8%? 6 to 8% means that it's a guidance which is much lower than the industry average also.
No, so I'll respond to that question. We said 6 to 8% for the full year. While it looks lower than the industry average, last year it's on the back of a lot of COVID product sales in the first and the second quarter. Okay, so therefore, if you look at, while we grew at about 7% in the second quarter, the first quarter plus second, we were almost flat against the last year. So the second half of the year will do much better and ensure that we grow at 6 to 8. Adjusted for that, obviously, we are at a double-digit growth. So, I mean, when we say 6 to 8, it includes that on a last year compared to the current year, and that last year has a high base of COVID sales.
And just in addition to that, because one of the key pharma investors here, believes that resolution of compliance issue at your Monroe facility is very critical for the US business. When do you expect the same to take place? Because the plant will need re-inspection, I'm guessing.
Sure. Obviously, we have been working on the remediation on the site for the last year or so, and we are hoping by Q4 of this year we should be in a position to start manufacturing the much needed injectable segments and others that we can do from there. So that's what we're looking at.
But in the meantime, I also wanted to understand the position when it comes to your net debt, because that has increased about 40% between FY13 to 21. Despite the fact that we've seen meaningful non-core cash inflows, healthy OCF during this period, what is the outlook on your overall debt, and what is it that you're planning to see over the next few quarters and years?
Sure. While obviously we are looking at almost a decade, but also we as an organization have grown substantially over this period. Okay, so I mean, we've almost grown. Many of the years we've grown at double-digit growths, and even the last year we grew at similar levels. So obviously the growth has come in. Also, as an organization, we've invested a lot on the innovation side. So these were one or two things that obviously meant that we needed to kind of ensure that we have enough resources to grow the organization. Okay. Now, obviously, while you look at the second quarter, it's gone up by about 280 crores. This is largely on account of the currency move. Okay, so you have seen that rupee dollar moved by almost like 6 rupees over the last 6 months. So obviously, that's the real impact why the gross debt is looking higher. And also in the last couple of quarters, we also seen some amount of challenges in terms of the supply disruption and therefore the requirements of additional working capital. So therefore, these are the reasons why it looks a little higher. Assuming that the currency remains at the similar levels and supply goes to further normalcy from where it is now, we should be able to see some meaningful reduction in the debt. And as you would know, last year we did manage to reduce our debt by almost 1,300 crores. So obviously, the intention and the endeavor is always going to be to reduce the debt.
Okay, Mr. Mani, great to have you on the show. Thank you so much for taking the time out and speaking with us today at ET Now.
Thank you very much.
Thank you. Okay, that's the word coming in from Glenmark Pharma. Let's just bring up that stock price up for you in trade. It's definitely lifted off from the session lows, still languishing in the red. All eyes